I kind of introduced myself so I can cut through that part. He's put this stuff up here. Yeah, I've been in the business about 20 years. Started off with a duplex and then walked away from aviation career with a duplex and about $10,000 in life savings. Didn't come from any kind of magic beginning, very humble beginnings. Started flipped houses for about 3 years. And that's how I kind of made a living for a while. And then got into my first multifamily, which was a 9 unit. So other than the duplex, first proper multifamily, 9 units. And then I think I did a 20 unit and then like a 27, a 44. And then I started getting into the larger ones. And that's where I started syndicating deals. And I've syndicated deals ever since then. I teach a lot. I have my own education platform and I teach and things like that. I've pulled some slides out of a longer slide decks. They said, well, you're gonna have about 30 minutes. So my slide decks usually takes me about 2 days to cover. So I'm gonna kind of try and cram about 2 days into 30 minutes. So I'm gonna show you everything that you need to know to be successful in multifamily in this next 30 minutes. I didn't say I was gonna teach you everything you need to know. I'm just gonna show you what you need to know so that at least you know where you have to go out and get that information, right? All right, so the first thing up, I have two books. These are my two books. They're both on, both of it bestseller on Amazon. If you're looking for a step-by-step instruction manual on getting into multifamily, that would be this book here, Real Estate Raw. That's one that I wrote like I'm talking to a coaching student, and it's 200 pages of how to step-by-step get started in multifamily. The second book, Creative Cash, that one is on using creative financing, such as seller financing, lease options, things like that. That's how I built my very first portfolio. So those are two books that I have out available right now. They've been out for about 2 years now. All right, so what I do is I like to go around and ask people, like, one of the first things you need to figure out in your multifamily business or when you're going forward is what do you need, right? So you want to kind of understand what is it that you need from a revenue or cash flow perspective. So I'll ask the room real quick, what is the number that if you had money coming in a month from passive revenue would make a difference in your life, right? I don't talk about being rich and all that, but just what's a good monthly passive revenue number that would make a difference in your life if you get it coming in? Anybody? Well, that's funny because that's usually about what most people say, $10,000 a month. How did I know? That is literally like 99% of the answers when I ask that question right there. Hey, if you had a number coming in every month, passive, what's that number? 10 grand. Or a multiple of 10, 10, 20, 30, right? So I've done you some math, all right? If you need $10,000 a month in positive cash flow, you have to have an understanding of where does cash flow come from equity, from the control or the ownership of something. Now, I'm not saying you necessarily have to own cash money, equity to get deal or to get cash flow. You have to have control of a deal, right? Because we could do something like lease option or seller financing, right? So $10,000 a month, great, super simple. No, I've got slides here. It's the only slide I brought. Okay. Oh, there we go. All right. So to have the $10,000 a month positive cash flow, all you need to do is invest $1.5 million. Easy. Write a check for $1.5 million at an 8% cash on cash, and that will equal $120,000 divided by 12 is 10 grand. All right. So look, all you got to do is write $1.5 million check to me or to Brock or somebody, right? We'll put it in one of our deals at an 8% cash on cash. That's $120,000 a year. Divide that by 12, there's your 10 grand a month. Thank you, good night. Look, that's all you have to do, right? Well, all right, what if you don't have $1.5 million to just haul off and invest? Then cash flow is not your agenda. You're already out on the wrong foot. You're not after cash flow. You're after the creation of the $1.5 million that goes to work for you. Because somebody's gonna get off that couch and go to work. Either you are or your money is, but somebody's getting off the couch and go to work, right? I mean, if your money is not going out there to work for you, you are, right? Cash flow or passive revenue is one of the most labor-intensive forms of money that you can ever go out and create in its creation, right? Now, once passive revenue is created, yes, then it's passive. But creating passive revenue is not from passive activity, right? Passive action does not create passive wealth. You have to be very active to create the $1.5 million for it to become cash flow and ultimately passive revenue. So the $1.5 million, that's what we're after. You're gonna have to go out and create that through flips, through wholesaling, through syndication, all the stuff we've been talking about this weekend. I do it through syndication. Syndication is where you go out and you're getting a chunk of the deal because you put it together. You and your general partners found the deal, you put it all together, you called up, somebody with the money and all that. Great. You're going to get maybe 30% of the deal and you're not putting money in, right? The down payment money is coming from the limited partners, the people you're raising money from. So through a syndicated model, you are literally printing money that does not exist, right? You're literally going to create that $1.5 million from nowhere because I'm going to go out, find the deal. There it is. There's a good deal. I underwrote it. I know what it is. There it is. Then I'm going to call up these rich guys over here and say, hey, I need some sponsors because, by the way, you have to have net worth equal to or greater than the loan amount in commercial real estate. That's something a lot of people don't know. So if I'm out here looking at a $1.5 million property and I don't have the net worth of $1.5 million, the bank won't give me a loan, right? Because the bank doesn't want to give money to poor people. Why? Because they can't hurt you. Bank is only going to give you something they can hurt you over. Honest answer. If there's any bankers in here, sorry for that. It's the truth, right? Bankers don't want to give you something you don't have. So they're only going to lend you what you have in net worth. This is commercial lending, not consumer lending. So if you're out buying a house or a car, it's very different. We're not talking about that. We're talking about debt service ratio loans here. So you get together your group, you're worth $1.5 million now, great. You can close the deal. Now all you got to do is go out and, like I said, we syndicate and raise that money from the other individuals. And every time you do a deal like that, you are getting a cut of that deal, money that did not exist before you did that deal. And if you do that enough times, you ultimately build up enough equity. And this is what I call the conveyor belt theory of real estate. I completely made this up. This is in one of those books. This is actually starting to get out on the internet a little bit. People are starting to share this around. So if you see this, you see anybody teaching it, jump up and go, hey, you stole that from Bill Hams. I made this up. People are starting to rip me off. This is what I call the conveyor belt theory of real estate. All right, what I want you to do is to imagine, oh, it's a little off. Imagine a conveyor belt, just like a normal conveyor belt at an assembly line or something like that, right? And our conveyor belt is going to be 5 years long. A little translation issue there in the format. So our conveyor belt is now 5 years long. In time, the conveyor belts are going to move to the right, okay? Let's see what this slide looks like. There we are. So year number one, let's say year number one is right now today. You're just now starting to get into the business. You're going to go out and close your first deal. Probably going to be smaller, probably going to be more like that duplex, maybe small apartment complex, right? And we're going to put this on our conveyor belt. That's going to represent a closing. Okay, as the conveyor belt moves to the right, that is time. That's going to be our operational window. Year number two, we've now closed our second deal. Probably maybe a little bit bigger. Maybe we're getting into small multifamily now. We're operating, we're holding, we're moving along. All right, year number three comes along. Now we're getting up a little bit bigger. Now we're getting into that multifamily. We've probably syndicating now. We're not doing some flips as much. We're building up our portfolio. It comes year number four, properties. We're getting into those bigger properties now. Now we're really getting in here. We're syndicating. Oh, by the way, nobody's mentioned acquisition fee. Acquisition fee is a fee, typically 1 to 3%, that we, the syndicators, get to charge our investors for being so nice as to let them give us money, right? So we typically, as a syndicator, will charge a 1 to 3% of the entire purchase price as a fee for putting the deal together. That's better than cash flow because you actually get it at closing, right? So here we are. Now we're number four. We're putting properties on here. We're really building our portfolio. We're still holding those first ones. They're all cash flow and we're operating. Year number five comes along. Year number five comes along. Okay, we're into bigger properties now. Now we have our first liquidity event. And this is why I kind of describe this as the conveyor belt, right? Your very first deal is now coming off the conveyor belt, and this is going to be a liquidity event here. I say liquidity event because it doesn't necessarily have to be a sale. Could be a refinance, right? You could refi and pull money out. But this is the key. So you're getting acquisition fee here. You're getting cash flow as you operate the properties along. You're building your portfolio. Now you're going to start upgrading this portfolio. Your first property, the older one, the little junky one, the duplex is kind of a pain in the ass. Sell that thing. Get rid of it, right? And as you take this capital gains here, you're going to roll that back around to the front, 1031 exchange or reinvestment of the capital. This is how you're going to build the $1.5 million that you need to get the $10,000 a month revenue. It's building this business model. And that's what Mike and I were up here talking about. It's just, it's doing this over and over and over. And over time, you build up your portfolio. You're getting bigger, you're getting bigger. You're going to quality. You're getting rid of that old junky stuff that's a pain in the butt. You're replacing it with newer, better buildings. Anybody want to talk about legacy wealth? Did anybody come down here with a concept of legacy wealth? I hear this a lot. I want to build generational wealth for my family. Okay, first concept, that's a terrible idea. You're gonna make your kids a bunch of trust fund babies, do we think kids they get a Corvette at 16 are the salt of the earth people? Like really? So first off, you're probably gonna grow up a bunch of snot-nosed brats that are gonna be rich kids. First comment. Second comment, it's just a dumb idea, especially with multifamily. Look, that building right here that was built in 1963, you're gonna give your grandkids? It's gonna be a pile of sawdust by the time they get it. They're gonna be slumlords. Are you kidding? You cannot go around here collecting up a bunch of real estate you think you're gonna give to your family 3 generations from now. That's stupid as hell. That property is gonna rot. Why don't you leave them a real legacy, a business, an understanding of the portfolio? That's the legacy you need to leave. You leave them the conveyor belt, not the asset on the conveyor belt. Right? That's silly. And so a lot of people ask, well, gosh, if I have such a great deal and it's cash flowing, why would I ever sell it? Well, for lots of reasons. They get old, somebody shows up and wants to pay you 10 years worth of cash flow all in 1 year, you take the check and you run. Why? Because you take that profit and you reinvest into a better, higher asset. And over time, you're building your conveyor belt out. And that turns into, all over the board. That turns into that, right? Okay, so that's what you're doing. You've got that cash flow going across the top. Liquidity event turns into equity, reinvests that equity, cash flow, and you run this model over and over and over, and that is where you ultimately start to build up that $1.5 million net worth, right? Now, over time, in every cycle of this conveyor belt, your net worth should be going up, your money should be going up, your wealth, and all those things should be going up. You're limiting the need for other people. Right? The first thing you're going to start doing, we're talking about syndication, the first thing you're going to start doing with all this equity is getting rid of your partners. Remember, we had to bring those first partners on because we needed the net worth. We needed the net worth to get the loan accomplished. So that's why we brought this person on. Well, hey, we have the net worth. Get rid of them. Now you're keeping a bigger cut of the pie. Okay, so as time goes on, you've got more cash flow, more money coming in here. Hey, maybe you don't need those investors anymore either. Right? Because leaving a syndicated deal in some sort of legacy model is not likely to occur. If you go out and try and raise money from investors and the investors say, hey, when am I going to get my money back? And you say, oh, I don't know, when the grandkids sell the property. See who invests in that deal, right? Nobody. Anybody in the syndicated deal wants to know several things. How much money are they investing? When are they going to get it back? And how much are they going to make? And when you tell them you'll get it back 30 years in the future, nobody's going to invest in that, right? The question kind of like time frames and surprising people. I wouldn't raise money on anything less than a 5-year window. I would tell everybody that's getting into one of my deals that it's a 5-year hold on average. And if we go long, that's okay. If you go short, even better, you give them their money back. But I would kind of always set the tone at about a 5-year window. That way, you don't get stuck. So I told you, this is my contact information. I told you I was going to teach you or show you what you need to know. All right, so first off, we have the conveyor belt theory. All right, I've been teaching for a long time, and what I've come to realize is that you get a ton of information in your head. You come to these events, you meet great people, you've read the books, you got all this information going on. You wake up Monday morning and you go, now what? Okay, so what do I do again? What was step one? We talked about syndication, that's great, and I'd love to syndicate, and I'm gonna make a bunch of money, it's wonderful. What do I do right now, step number one? Okay, that is where someone in your corner that knows the business will help you out. That's where a mentor comes in. That's where working with people like myself or the fellas here, will help you go to the next level, right? Because it's great to come to these events and it's great to learn this, but it's very difficult to teach you all how to truly build and run a business, from stage over a weekend. We're hitting high level points. We're hitting the, you can do this and it is possible, and we're trying to get this kind of information to you. But it would probably take me about a week of standing here 8 hours a day talking to you for me to fully explain the business and to make sure you had everything. And that wouldn't even cover like case studies and you running into problems and questions and answers. You really got to get out and find someone in your corner to help you go forward in the business. It's one of the investments that's invaluable. I really recommend these days that you spend some time doing some research on anybody before you pay them money for their advice, right? There are a lot of people out here trying to teach that should not be out here trying to teach right now. They've closed one or two, three deals. They've done it over the last 2 or 3 years, and now they're teachers. Well, let me say this. If you've been in this business less than 10 years, you've only seen the good times. The last 10 years, the market has been on the up. Now, I'm not trying to take anything away from anybody, but you've not been tested. Don't get cocky, right? Don't think you're smart because you made money 2 years ago. Everybody made money 2 years ago in multifamily. I'm not taking anything away from anybody, but it's like, don't break your arm patting yourself on the back. Times have been great, right? So we're in a market cycle shift, and that's something I teach a lot about is market cycles. There are 4 market cycle segments. You have the recession cycle, which is your down, you have trough, you have the inflation cycle, the upside, and then you have peak cycle. So those are your 4 business. It's up level, down level, basically, right? So from 2008 till my year or so ago, maybe a year and a half ago, we were only in an up cycle. Prices and values and everything had been on the rise. As we said, Warren Buffett said, you know, when the tide goes out, we get to see who's skinny dipping. Well, the tide has been in for a long time, and I think that's made the market a bit overconfident. And so then all of a sudden the rates go up, and that is part of the market cycle. Well, what you have to follow is inflation, right? A market cycle is actually an inflation cycle. So that's the big key to watching all this stuff. Just watch inflation. If inflation is low or not rising much, the Federal Reserve won't really raise the interest rates much. So it's very predictable as what interest rates are going to do. When inflation starts to rise, the Federal Reserve will always suppress that with interest rate rises. Well, you know, yes, inflation went up some and all that, but after COVID, right? After COVID, the stimulus money that went into the world was unprecedented, right? If anybody wants to look it up, you can look up what is called M1. You have 3 different types of money supply in America, M1, M2, M3. I'm not going to go through all that, but if you want an interesting chart, look up the Federal Reserve, look up FRED. It's the Federal Reserve of St. Louis, Missouri. All you have to do is type in M1 monetary supply, and like the first chart that pulls up will answer it. Look at that chart. Look how much money the government put into the world since COVID. They injected more money in about 6 months after COVID than existed in the last 60 years. So it was more money put into the system than the last 60 years combined. But interest rates are going to go down next week. Yeah, like hell. Let me tell you, they're not going down anytime soon. They may come down a little, but they're going to level back off around 6, 7%, 6%. Most of my career, real estate loans were 6, 7%. It's normal. Over the last 4 or 5 years, all of a sudden the loans went down. Yeah, everybody that's young to the business have gotten kind of comfortable in an off cycle. 6, 7% interest rates are totally normal, right? It is not crazy. It's not the market and the world's coming to an end or anything stupid like that. And by the way, who cares? Who cares what the rates are? Who cares what the price is? I only care that I'm going to make money off the deal. That's all I care about, right? I don't care what your price is. I don't care what the interest rates are. I care whether I'm going to make money. Now, if the interest rates go that way, yeah, I'm probably going to have to pay you less for the property for me to make money. Yes, probably. But that's not a direct equation. We don't care. Interest rates, market cycles, who cares? Go out, look at deals, learn what a good deal is, network. And that's all you really have to worry about. And those are the 3 things that you have to have. These are the 3 things I told you I'm going to show you. Deal flow, deal analysis, networking. Those are the only 3 things you have to master in this business, and you're good outside of that. Deal flow. Everything anybody ever is going to teach you will fall under one of those 3 categories. Deal flow. Okay, well, that's choosing a market. That's working with realtors. That's going directly to owners. That's getting deals coming in the door. 3 a week. I recommend that whatever size property you're trying to look at, whether it be duplexes, 100 units, or whatever, you need a digest of 3 of those every single week. You need to be analyzing 3 deals a week. If you're not finding 3 deals a week, add territory. So I recommend kind of like start with your house, draw a circle around where you live. Inside that circle, you're going to find 3 deals a week, right? And so what you do is if you're not finding 3 deals a week, you increase the circle until you're bringing enough territory that you're finding 3 deals a week. Don't hopscotch around the country. Oh, I heard Dallas was a great market. I'm over there. Oh, I heard Atlanta. No. You're going to be all over the board. Start at home, work your way out, 3 deals a week. Okay, that's one. Next, deal analysis. You got to know the numbers. You got to know what a good deal is, right? And so once you know what a good deal is, now all you got to do is just look at more deals than everybody else. You win. So deal flow, knowing what a good deal is, and that's what we help you do, is teach you the math and understanding what a good deal is, because in there is where you'll figure out, can you syndicate, right? Does this deal make enough money for me to get a cut, sell some to the investors, they get a return, cash on cash, all that fun stuff, right? That's deal analysis. And then third, you gotta have the network to help you take those deals down, and that's what you're doing here right now, right? I mean, none of us are up here alone, right? I know Mike has done a ton of real estate. I've done a ton of real estate. None of us have done it alone. None of us stood up here and said, hey, we scratched the lottery ticket, got rich, and won a bunch of real estate. No, nobody said that, right? We all started up here, same place you did, basically nothing. We kept coming to the events, we kept networking, and we just kept doing the business. You know, I've known Jeff and Adam for some years now, and they're still here, right? I remember when we first started talking to Jeff, he was brand new, didn't know shit from Shinola when he got started, right? And look where he is now. And so, but that's time in the market that's doing it, and it's being here and it's doing it. So don't be in a hurry. Know that the three things you absolutely have to have: deal flow, deal analysis, and a good network to put things together. And if you can do that, all this other stuff's irrelevant. The market's up, the market's down. Who cares? The interest rates are up, the interest rates are down. Who cares? A good deal is always a good deal. And it is always the right time to buy a good deal. Might not always be the right time to sell one, or maybe not always the right time to refinance one, but it's always the right time to buy real estate if it's a good deal. All right, I'll end it on that one. This is my website, realestateraw.com. It's the same title as the book. I have a ton of free information on there. You know, you've got a big giant blog full of lots of articles. You guys can go read all those. That's my email. I didn't mean for that to be blue like that. It's Bill at Go Broadwell if you can't see it. Not going to give you a gigantic sales pitch, but I also have a mentorship program. If you would like to speak to me about it, you can either go to the website, or you can email me, or just come find me this afternoon. I'll be happy to talk to you about it. I'm going to be here for dinner. They've been kind enough to invite me to dinner as well, so I'll hang out here tonight. And I'd love to answer any questions anybody has about the market, where we're going, where we think we're going. You know, I've been through 2008. I've been through all that. Starting to look pretty familiar around here again. So I'm super excited about multifamily going forward. It's going to be a tremendous amount of opportunity. So I just want to leave it on that note. Be excited. Oh yeah, I'm sorry. Yeah. If we got a few minutes, yeah, questions. Anybody got any questions? Let me know.
Any questions? I know it's that afternoon lull. Everybody's getting a little tired. Get the coffee back there. Get jacked up again. Nothing. Oh wait, we got one.
Yes, ma'am. Exit. Okay, well, first comment, I don't own any real estate. I already exited. I've sold everything. I actually still own that very, very first duplex I ever bought. It's been abandoned for about 7 years, tree growing through the middle of it. Still own that piece of crap. Everything else I've sold for no other reason than I made a bunch of money doing it, right? Everybody kind of asks that, oh my gosh, you sold everything, you're out of the business, you're retired. No. I bought low, I sold high. That's what you're supposed to do, market cycles. We sold everything year and a half ago, over 20 into 21-ish through that range. Largely just because people came up and were wanting to buy the property. Two of my 3 assets that I sold last, totally unadvertised. Somebody just walked up and said, hey, we want to pay you a lot of money. And we're like, yeah, we're in the business of cashing big checks. So we sold those. Third one was a little more strategic, CapEx. It was an older property and we were getting killed in the plumbing and the repairs, and we really weren't cash flowing because we just kept trying to keep the building alive. And we had a buyer come along, pay us all of our investors' returns that we had projected plus. So we exited that one. But now I'm right here doing exactly what I'm telling all of you to do. Network. These guys are not paying me. I did not come up here because they're paying me to be here, right? I'm here just to network with you all. I love teaching, but this is an excellent opportunity to get out and meet new people and network because I raise money just like everybody else, right? I'm sorry, what was that? No, I did not on those. No. So on all those deals, I did not. I paid off the investors, which, by the way, a 1031 exchange in a heavily syndicated deal is a little tough because you kind of either have to take all the investors with you or you have to buy them out of the LLC prior to a sale. So the last deals I had were all syndicated deals. We just paid all of our investors out their money. They all got, double-digit returns. We paid our capital. My partners and I paid our gains. I cleared all of my life debt. So I owe nobody anything, and now I'm sort of millionaire homeless person, sort of. Yeah, so any other questions? Yes?
You might have talked about it already, but property management. So it's a pretty common theme for larger syndicators to build management
no. Oh, hell no. No, 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 no. No, I started off managing that very, very first duplex I ever bought. And I hired a management company or two along the way, and they sucked. And I thought, well, all right, I can suck without them. I can pay myself to suck, right? So I started managing the properties all along, and then it got bigger, and I started hiring friends, and then I hired my girlfriend at the time, who is now my wife, and I built a 16-person management company. And it was great. And management is consistent revenue, so that's good. But don't let anybody tell you that property management is free money. It is pure brain damage, right? I mean, yeah, you're gonna get paid, but it is a lot of work. So I recommend that you manage, don't manage, then maybe manage again, right? So manage a little bit in the beginning to learn and then stop, because it's going to turn into a big opportunity cost. And that was a mistake I made, was where I probably, once I learned management, I should have started hiring third party and become a better asset manager, and I would have grown my portfolio bigger. But I spent a lot of years literally being the person over there dealing with the property, or the manager didn't show up today, so somebody's got to go over there, I go. You wind up wearing a lot of hats like that, and I've got an incredible amount of experience from it, but I don't want to do it again because I'm not 100% sure the money is in there. So if you're asking me personally, no, I'm not doing that again. I'm going to now outsource to third-party management. Yes, but I'm going to buy newer, easier to manage buildings. See, there's another one you're not asking. It's like, well, if you go buy older, tougher properties in tougher markets, all management is going to struggle there. So I'm going to buy nicer, newer, blue chip type properties, higher management, and then be a good asset manager. That's me, but I can't say that's necessarily the path you should take. I do think everyone should get some management experience, but understand it's not free, and it does come with a big opportunity cost. So long-winded answer there, but yeah, no, hell no, I'm not doing it anymore. You could do it, but I'm not doing it. Yeah, any other questions? All right. That's it.